Welcome back to another video. Today I want to talk about put debit spreads and call credit spreads and how we can utilize these option strategies in order to limit our risk and increase our profits. So most people know what calls and puts are, but just as a friendly reminder, the basic summary is if you buy calls, you're expecting the stock to shoot up in value. If you're buying puts, you think it'll go lower, and in order to make money, you have to make the break even, meaning your strike price plus the premium you paid. So for example, a 391 call plus $250 of premium you would pay would have a break even of $393.50, meaning that if it were to go higher than 393.5 during expiry, you would make some sort of money. And if it were to remain lower than this price, then you would lose your money. So what is a put debit spread? So the main option strategies we will be discussing is more towards the downside, since most people believe, we'll have a recession or we'll have an economic slowdown, so the market would go lower. So right now we can see a 390 put is pretty expensive. The break even is 386.64. So you would have to invest $336 for, a standard at the money put, which is, quite expensive for people. And if it doesn't fall, to 1%, then you would lose $336 by Monday. So how can we limit this risk? What play the strategy? So say if we believe the S&P would fall, but we don't know how much. Just say if we, bought a 391 call and we sold a 336 call. So that means that if the S&P were to either remain near its price or go even a little bit lower at 390.45, meaning that we are just assuming that it would stay flat or go down a little bit or go down as much as it needs to, we would gain a profit of $45. So how would we gain a profit of $45 off of a $55 investment? So essentially we are paying $55 for the ability to buy the 391 and sell at 390. So if the S&P at the end of the day is below 390, we would get our full profit, which would be $45. And if it's below 390, we would lose $55. And if it's in between, as you can see by the scale, depending on where it is, for example, if it's $390.50, we would only lose $5 since we paid 55 cents. And at this point, our break even is 390.55 because we paid 55 for it, and our lowest strike entry is 390. So 390 plus 0.55 or $55 would be 390.55 being our break even. So I really like the strategy because you're getting a pretty high ROI, especially since, in order to get the same ROI of around 80%, the S&P would have to drop 3 or 4%. But in this situation, it would only have to be stay flat or, go down only a little bit. So I use this strategy quite a bit when I want to, de-risk, but also have, the same upside potential in terms of return on investment. So let's see the same thing, but instead we'll be looking at it on the call side, and we will be doing a put credit spread. So put credit spreads and the previous thing I showed you, the put debit spread, is also very helpful. It's basically the same strategy. However, this you'll be receiving a credit. So say you sell the 390 call and you buy the 391. Essentially, you have the ability to sell the top part and you're buying the bottom part. So you would get a credit, meaning that your collateral would be $100, the difference between the strikes of 391 and 390. And you would credit 47, so your max loss would be $53. So in this case, it would be very similar. If the S&P were to stay flat or go down a little bit, you would gain a lot more. So you would get to keep your full credit amount. For example, you paid $53 for this spread, since 100 minus your total credit that you receive, 100 minus 47 is $53. So your $53 would essentially be the amount that you give them, and $47 would be the credit you get back. So how that would work was essentially the same thing. If the S&P is lowered, then you get you get to keep your full credit amount. But if it doesn't, you lose your credit amount would be $53. So again, same type of strategy. I would highly recommend to look at this more into detail. I've used these strategies a lot in the past and will continue to use it, especially since option premiums, meaning how much you pay for a contract, is up quite a bit due to the volatility, while put credit spreads, call credit spreads, call debit spreads, put debit spreads have increased, have stayed the same relatively in terms of a premium. So yeah, I would definitely look at it. Personally, I am looking towards some call debit spreads where essentially I'm betting on the S&P would go higher. I think we do see a dead cat bounce here a little bit. So something like, say if I think it'll go up, 2 or 3%, but I don't want to take the risk of buying a call straight up. Maybe I can buy at 394, sell at 395. My total cost would be 40 cents, and my max gain if S&P were to go above 395 would be $60. So this is a great strategy in order to minimize risk and increase your overall ROI. And I think you should look more into it. You should definitely Google and research more about this. And yeah, thanks for watching and have a good day.